Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Today I'm going to take a look at Kroger. This is a simple business. They own a bunch of grocery stores. They are potentially acquiring more grocery store from Albertsons, which we'll talk about quickly. And they also own a couple of other things outside of grocery stores, like VitaCost, for example. It's an e-commerce website that sells supplements. But you've probably seen some of their brands. Kroger obviously is the main one. Harris Teeter, Fred Meyer, Food for Less, not food and stuff, it's food for less, but close enough. So quickly looking at their earnings, they were initially thought of as pretty good by the market. The stock was up maybe $2 from their current price point of $45, but it's quickly retreated in the last couple of days back to where it was right before earnings. What was driving the earnings? Really, what you see from grocery stores and what you see from Kroger is relatively slow growth year over year on a same store basis, on an earnings growth basis, on a revenue basis. This isn't a business that's going to grow 20 to 30% a year. It's very much in the 1 to 4% neighborhood. Same store sales, identical sales without fuel were about 1%. And there's a one here that says, hey, if we didn't terminate our Express Scripts deal with our pharmacy, it would have been more like 2.6%, but we lost a bunch of revenue because of that. But that's you did terminate it, so it is what it is. GAAP profit and GAAP EPS were actually very negative. That might be thought of as bad, but it's due to a 1.4 billion charge related to a nationwide opioid settlement. So you think, why are they doing an opioid settlement? Well, it's because they have a pharmacy and they sold opioids through their pharmacy. They are highlighting their digital sales being up 12%, but digital sales from a grocery store basis, it's still not a huge part of their business. It's something like $10 billion out of a $140, $150 billion annual revenue. And then you've got your adjusted EPS and adjusted FIFO operating profit with 7% growth. So decent earnings. You do have to remember that this one-time settlement is going to be an overhang over the next 11 years. I think it's 1.4 billion paid out over 11 years. So it's being taken as a one-time hit to earnings in Q2, but from a free cash flow perspective, they're going to pay that out across 11 years. And they also have another charge that they're taking across 7 years that they took in 2021 related to some of their restructuring of pension plans. So you can kind of see identical sales without fuel for 2023 full year. It's going to be in the neighborhood of 1 to 2%, would have been 2.5 to 3.5% with Express Scripts still in there. Earnings are going to be 445 to 460. And then really what we're looking at is free cash flow at 2.5 to 2.7 million. That's adjusted for those things that I talked about, whether it's the pension stuff or whether it's the opioid settlement. So a bunch of nonsense here you can go through yourself. But what is Kroger as a business? It's a supermarket that sells fuel at a gas station that attached to the supermarket, that has a pharmacy that's usually within the store. And they also have this alternative business where essentially if you're a Kroger member, or really any grocery store will have this, if you're a grocery store member, they give you a card that you scan to get your coupons to work, whatever, store coupons, store sales, and then they gather all of that information and they sell it to other companies. You know, if you're Campbell's Soup, for example, maybe you'll go to Kroger and you'll pay them a bit of money to look at customer shopping habits because they have all that information and they make a decent amount of their profit from that side of the business. It's essentially their marketing business. This is a company that has maybe 1 to 2% margins any given year, and a good portion of that actually comes from selling the information that you give them by buying stuff there. So the supermarket business model is very, very low margin. So there's other ways that they make money besides selling you lettuce. And Kroger has done a good job of kind of making sure that this holds true. They have delivered 8 to 11% returns, and that's kind of their goal on a long-term basis, 8 to 11% returns. And they do that through a combination of growth. Again, growth isn't huge. You're talking 1 to 4% on the earnings side, maybe a bit higher. They're also buying back shares, and they're also giving dividends out to shareholders, something in the neighborhood of 2.5% at the moment, and growing any given year. The interesting thing about Kroger is it's a very dependable business. They do make money. They have a ton of revenue because people need groceries. Their margins are very slim, but they're consistent, and that's kind of why the stock has done relatively well in recent years. So they kind of sell their investment thesis here. They have 2,700 locations. They have that first-party data on 60 million households. Earnings growth is going to be in that 3 to 5% range. And you've got a cash payout, which is a combination of dividends and share repurchases. in the 5 to 6% range, which gets you to that 8 to 11% range. Pretty good net debt to EBITDA rating. Not a lot of debt at the moment in relation to the EBITDA, but that is soon to change. They are making an acquisition that is going to increase their national footprint if it gets approved by the Federal Trade Commission. Certainly some competitive risks with something like this. If they buy all the all the supermarkets in one location, could be a problem, which is why another part of this earnings was basically them saying, hey, we're going to divest about 400 of the 2,200-ish stores that we're acquiring from Albertsons to CNS, about 8 distribution centers, et cetera. It's mostly in areas where there's a significant overlap, so Arizona, California, Colorado, Wyoming, et cetera. And it's a combination of other stores. It's obviously they're not going to use the Kroger brand name, but they are still able to use the Albertsons brand name in those areas where they're selling these stores. So Kroger's going to own a good portion of these stores, but not all of them. So when you talk about the national footprint over here of 4,900 stores, it's probably going to be closer to 4,500 stores after the divestiture if the merger goes through. But again, it is going to be a much bigger business. This is a business that's $148 billion or something like that. Just Kroger alone, it's going to be 210 billion plus when combined with Albertsons. Their goal is 8 to 11%. With Kroger on a standalone basis, they think they can achieve more than that with Albertsons in the first 4 years post-close. There's going to be $1 billion in synergies that they claim, and a better way to grow that alternative profits, high growth, high margin business, and better free cash flow. They're saying 30% accretive to total annual adjusted free cash flow, which isn't a ton, but you have to remember that they're taking about $17 billion in debt to fund this acquisition. Maybe it's going to be slightly less with the divestiture they made, but that is going to create a significant amount of net interest in payments that they don't have to pay now. We're probably talking anywhere in the 1 billion, maybe a bit more range on an annual basis. Now they're going to start paying that down. They've already said we're going to stop purchasing back shares in order to pay down debt when this acquisition happens. They've already paused that share purchase program because they're trying to collect cash so they can really deleverage once the acquisition does happen. So let's look at Kroger as a company. In the last 3 months, down 3%. In the last year to date, they're basically flat. In the last year, they're down about 8%. But if you kind of zoom out more, 3 years out, they're up about 11% a year within that 8 to 11% target. 5 years out, they're up about 9% a year, 55% total within that 8 to 11% target. 10 years out, 124% up over the 10 years, 8.5% on a annual return basis within that 8 to 11% target. If you go 18 years out, 9.3% annual return. So this is very consistent. If you're looking for 8 to 11% that they claim, it's doing that for you. And it's doing that through a combination of slow earnings growth, share repurchases, and dividend payouts due to a growing dividend. If you look at their financials, these really tell the story. If you go all the way back to 2002 on a net income basis, they make money. That's essentially what happens. Yes, it's low margin. You can kind of see 0 to 2% margins, but they've only lost money on a net income basis once in 2005. Even in 2008, 2009, 2010 during the recession, still net income positive across the board, basically forever, right? That's kind of what you get with Kroger. You get a consistent business. It's not high margin, it's not high growth, but it's very consistent, which allows them to buy back shares, which allows them to increase their dividend. You can kind of see the same thing on the cash flow statement. You can go here and you can look at their free cash flow, graph it out all the way back to 2007. We can go further back. They are generating free cash flow. They have never once been negative on the free cash flow side, all the way back to 2002. Now, this is a business that existed since 1988, so I don't have that data before then, but you can kind of see they've gone through a lot of ups and downs, and from an economy standpoint, and they've always made money, which is a good thing as an investor, which is why they've been so consistent, which is why they've returned so much consistently, and I think that that's a good thing if you look at something from a long-term basis. Now, there's a question mark. Now, this merger with Albertsons, is it going to go well? Are they going to be able to achieve that $1 billion in synergies within 4 years? A lot of times that sort of stuff can go wrong. It can be slower. The integration can be worse. The strong free cash flow accretion isn't going to be huge initially. It's only 30% by year 4, which isn't a ton when you consider that Albertsons on its own probably would, if you just didn't do it with debt, would do like 70% accretion, but they're taking on so much debt that that free cash flow is going to be reduced by the amount of interest that they're going to pay. At least initially, they're going to use a lot of the free cash flow that they generate to pay down debt, so they're not going to be buying back shares. Maybe the dividend's going to increase at a slower pace a little bit, but in general, I think they're still going to be in a good spot to pay down that debt because of the business they are, right? People need groceries. If the economy sucks, people are still going to get meat and potatoes, right? That's just what happens from a balance sheet perspective. They are looking okay. The big question is, are they still going to look okay after the acquisition? They've kind of increased their cash on the balance sheet simply because they're going to start paying down debt as soon as possible. So every year they're going to work that down. They do have about 12 billion in debt on the books right now, about 6 billion in capital leases. Then you add, 17 billion on top of that, some of that being capital leases potentially that Albertson has, maybe a little bit more if you include capital leases. That is going to change their balance sheet in a big way, right? This is a $32 billion company, something like that. As of right now, 49 billion on enterprise value. Their enterprise value is going to go up quite a bit, but a lot of that is going to be debt that they're going to be paying down really, really quickly, or they'd like to pay down really, really quickly at least. So on a valuation basis, there's a lot of ways to look at it. I'm going to look at it from a free cash flow perspective soon, but from an earnings perspective, if you go back, basically to 2008, they've really been in that 9 to 20x range. And right now they're sitting just north of 9, just shy of 10, I suppose, 9.9x multiple, which is pretty lean. They were there in 2019, they were there in 2017, they were a bit lower in 2012, they were kind of there in the height of the recession. So this is a stock that kind of ebbs and flows, but this isn't really out of the norm. Maybe the mean is a bit higher, but the mean is elevated by these 20x multiples that they were getting in 2015 that never really held. A lot of times this stock is just valued in that 9 to 12x range by the market, so it can ebb and flow, but it seems like a really good value on paper, but this is just how the market has always valued the stock. If the story somehow changes, if they can maintain margins at a heightened level for an extended period of time, if they can grow faster, maybe the market will revalue it. But this is sort of what you're getting. So you do need to depend on that, consistent earnings growth in that 3.5% range, 3 to 5% range, the dividend growth, the dividend payout, and share repurchases, which remember are paused right now. So maybe the market's thinking that since they're going to be focused on debt, their growth isn't going to be that much different. With Albertsons, maybe a little bit better. Maybe they're going to get a bit more free cash flow, a bit more earnings, but we're not going to revalue it yet until we see what actually happens, until we see those synergies materialize. Because remember, those synergies are probably necessary to grow that free cash flow because they're needed to offset the massive pile of debt you're bringing on. So certainly not a bad deal by any means, but I think if you're looking at this from like, wow, it's a 9x multiple, a 10x multiple, this is just kind of how the market's always valued this stock. Yeah, there's some upside if it goes to a 12x, 20% upside, etc. Think that's certainly maybe worth looking at because this is such a consistent performer, but it's not going to rock your house. Now, obviously, if the market reprices it to 20x like it did a couple of years ago, there's substantial upside, but it's just hard to see that happening when it didn't happen during the pandemic, when this thing just exploded in terms of their margins and growth in relation to what they normally see. It's not like it was exploding, really. So let's look at the stock analysis. There's some estimates here. I'm just looking at it from the perspective of Kroger on a standalone basis. I do have a quick analysis from a combined basis that I'll look at quickly. I am being kind of maybe conservative in terms of their margins. You can kind of see the estimates point to 1.9 to 2.3% margins in the next couple of years. I'm more in that 1.5 to 1.8% range. I am using real free cash flows, not adjusted free cash flows. So you can kind of see that they were estimating 2.5 to 2.7. That's why I'm at 2.32, because I'm saying that, hey, you're going to lose 200 plus million to that settlement, to that pension stuff. So it's real money that exists and is going to be there for the next 7 to 11 years. So to adjust it when there's probably additional one-time costs eventually that are going to replace it, it's kind of whatever. I'm just not doing it. And when I look at it this way, I sort of look at growth being very anemic in the next couple of years, 1 to 2% essentially, close to what the projections are saying, maybe a bit higher in 27 for the projections, but not a lot of estimates for that year. And with that, which I feel like are relatively conservative assumptions, I'm basically saying that the majority of the value here is going to be in that 5 to 8% range, the majority of it in that 6 to 7% free cash flow yield. You can kind of say, well, the market today is pricing it to a 4.3. Why are you pricing it to a 6 to 8? Well, the 4.3 is based on a 2023 actual that was impacted heavily by some inventory issues that they basically pre-bought a lot of stuff due to fear around inflation going into next year. So that was a bit understated to what it normally would be. If you kind of go to 2024 estimates versus current market cap, it's more like a 7%. If you go back to what actually happened in 2022, it's more like an 11% valuation. So I think I'm being relatively fair there. If you kind of look at 7% valuations, the returns are actually a bit worse than if you look at 5, which are a bit higher. So if I'm targeting a 10% return, kind of using these scenarios and these weightings, I get a fair value of about 42.50. And when you think about a 10% return, that's a 10% return pre-dividend, so you still get another 2.5% on top of that. So if you're targeting a bit lower as an investor, you can certainly make a case that today's price at, let's say, at 8% return is a pretty fair deal. It's 46.60 at an 8% return against a current price of 45.11. So to me, this feels fairly priced right now. Now, obviously, if the market reprices this to a much better multiple, if you go to 4 to 3% somehow, if you feel like that's fair, you're kind of looking at a 19 to 26% return at after dividends, right? This includes the dividend yield. If it stays in that 5 to 8% range, you're looking at anywhere from 6 to 14 to 15% returns if you go from 8 to 5% on a free cash flow basis. Now, if you're saying, I think the fair value of something like this is a 7% free cash flow yield, which is kind of what the market price is pricing it to, you might need a slightly lower fair value than you're seeing today at about $37 to kind of hit that 10% target return. But if you go a bit lower, if you target a 7% return, for example, which is going to be closer to 9.5%, 10% after dividends at that 7% yield, the fair value is about $42.50. So to me right now, Kroger seems fairly valued. It doesn't seem like an amazing deal. I think 10% target return on something like this is a bit optimistic. You're probably closer to like 8.5 if you're aiming at that top end of 11 that they're aiming for as a business. And at 8.5, the fair value is 45.54 against the current price of 45.11. Certainly reasonable pricing. This is a stock that you look at and you say, yes, this is fairly valued. If I buy it today, am I going to probably get that 8 to 11% that they're targeting? Probably. The only concern would be as an investor, they're taking on a ton of debt to integrate this unknown company. Unsure if this acquisition actually happens. If the FTC says, no, even with the divestiture, you can't buy it, that could be a good thing or a bad thing, depending on how you look at it. If that were to happen, they're not taking on that additional debt. I'm only assuming 10% buybacks from their free cash flow in the next 5 years. Maybe that's even overstated if they're entirely focused on paying down debt. But if they were to say, well, the acquisition is not happening, you can see these guys really pump up the buyback, buy back a ton of shares, and then the fair value is actually way better than it is today, 6% better. Other upside is, hey, maybe the actual margins by 2028 are going to be better. They were able to hit 2.5%, 3% margins during the pandemic. The problem is that prior to the pandemic and really around the pandemic, the real margins are often in that 0 to 1.5% range. So that was maybe an outlier. So I'm getting closer to the 1.5% range than the 2.5% range. But if you say that they can hit 2.5% margins consistently, if you think that's the case, this is a great deal because that changes the calculus quite a bit. They're going to generate way more cash flow in the future. And maybe that is the bull thesis that you have here, that once they get Albertsons integrated, the synergies are really flowing. They've paid down that debt so that the interest isn't a big overhang. Their cash flow could be in that $4 billion plus range. And then you're talking about 11 to 30% returns at a very good free cash flow yield. That's probably never going to happen for this company. But let's say 11 to 17% returns in the 5 to 7% range, which is really good if you believe that that's the story. Now, looking at it from a combined basis, this is going to be a quick look here. I sort of got to the same price point. You can kind of see how the business looks. This is without divestitures because who knows what that's going to happen. I'm assuming similar margins because there's pressure from interest on the free cash flow of the combined company. But you can kind of see this is a company that had $6 billion in free cash flow in 2021, almost $6 billion in 2022, only getting back up to about $4.4 billion by 2028. and the price point is kind of in line. I'm kind of making some assumptions around market cap, putting the current market cap of Albertsons into the market cap instead of the debt, just to make it a simpler calculation. Similar weighting here. So the valuation is about the same. I think the Albertsons merger in general is going to be a positive. In my mind, it's going to be a positive just because the synergies will likely happen. It might just be a bit of pain in the first couple of years as that debt really impacts the bottom line because of the amount of payments they have to make and the fact that they're not buying back shares. They've done a good job of taking their share count down quite a bit, which creates shareholder value. They've went from like 850 million in shares in 2017 to 719 million or so right now. That's going to pause. They're not really going to issue a ton of shares, but you can kind of see the buybacks that they've been making were in that 1.5 billion range outside of the last year when they kind of made the announcement of the merger and said we're pausing our share purchases to collect cash to pay down debt. For me, is this a buy? I know probably. I think I'd need to see something slightly lower than the $45 price point. If I were to target, let's say, I'd be pretty safe targeting maybe an 8% return here, which at this scenario fair value is about $46. But I'd probably want something closer to 10% or 8% prior to dividends at these lower free cash flow yields. So we're talking 7 to 8%, which would mean a fair value in that $35 to $41 range, which probably won't happen. I mean, this is a stock that's relatively steady, and this is a stock that is probably fairly valued right now. But if a market downturn were to happen, and I wanted something that could provide potentially returns in excess of the market and be a pretty safe haven during a recession, this would be a stock that I would certainly be looking at in a price point that's not too dissimilar from where it is today. Could this go to $41? Yes. Would I buy a bunch at $41 and below? Yes. Is buying some now reasonable and probably going to net you a good long-term return in the neighborhood of 8 to 11%? Totally. This is a good company, a relatively fairly valued stock. But right now I'm just a bit more conservative in my purchases than I normally am. And if I'm looking at something, I really need it to be a smoker of a deal. And I think right now this is just a pretty fair deal. So that's what I think. Let me know what you guys think in the comments down below. As always, guys, please do your own due diligence. Talk to a qualified financial advisor before making any investment decisions. I just do this for fun. If you liked the video, leave a like. Subscribe if you're new to the channel, and welcome to all of you that have joined the channel in the past couple of weeks. I do plan to make these videos on a regular basis, so let me know what you guys like about them. Let me know if you have any comments, what you dislike about them, anything down below. I read all the comments and respond always. So thanks for watching and have a good rest of your day.